Hello, good morning. Welcome to the session once again. For the last seven sessions, we were discussing about the introduction, forms of business unit, basic terms, terminology in accounting, and rules of debit and credit, journal entries, and all. Last we have done three sessions continuously. Rules of debit and credit, and gap also we discussed. Generally accepted accounting principle. Now, as we almost completed the major portion except financial statements, now we can try the MCQ questions, how to solve the multiple choice question. Because as per the guidelines, new guidelines, you know already, 70% of the questions are MCQs. So we have to practice more and more MCQ. And the rest of 30% only coming from case studies and practicals and all. Out of this itself, around 10 marks out of 30%, 10% comes from the practical related to journal entries and adjusting entries. So almost 70 plus 10, 80% of the area of the question we covered already, because 70% is multiple choice. We are going to start today multiple choice. More than 100 MCQ questions I prepared already. We'll discuss. We'll discuss means we'll discuss the very important points. That means why the answer, how to find the answer. From this 100 question, if you observe very carefully, that you can, I think you can answer any type of. In this 100 question itself, I include HOT and LOT both. As per the ICCA guidelines, we have 40% in a question paper, there will be 40% HOT, higher order thinking level, skilled question. And the remaining 60% is LOT, lower order thinking, then easy question, comparatively easy question, knowledge level, not analytical or highly, higher order thinking level. So I include that both almost equal, 50-50, 50% higher order and LOT type question 50%. So if you go through all these questions, 100, I think 105 questions, 104 or 5, so more than 100. So almost this 100 question, if you go through, you will get a clear idea. Then any question when you're getting, you have to think in that way. Actually, I don't like to study the question. That means the question and answer. For example, 100 question in a PDF file I'll give you, you will study that. That will not create any, enhancement in your thinking, skill level. You will by heart and you will write for exam. You have to think why it is correct. That is why I want this 100 question, full 100 question we'll discuss, and you have to understand how it comes the answer, how it is, not just by heart. That is, I think, the most one of the most shortcoming of this diploma. And also I want to tell, these questions are not just exclusively for diploma first year student. Diploma first year, diploma second year, that means principles of accounting 1, principles of accounting 2, and intermediate 1 and 2, corporate accounting 1 and 2, all the 6 courses. Now it is multiple choice question. That means 70% multiple choice question. ICCA guidelines is already applied. So all the 6 courses you will be applied. It can be applied. It will be useful for you. So up to advanced diploma. Then BTech, there are management accounting also. We are not discussing. Analysis we are not touching. So these 6 courses. That means principles of accounting 1 and 2, and intermediate 1 and 2, corporate accounting 1 and 2. All the 6 courses, these 100 questions, 100 MCQ will be, if you apply, if you study, if you understand exactly the effect, cause and effect of this each question, it will be a very, it will help you a lot in your, in all these courses, for understanding as well as for attending MCQ questions. So we'll go to the slides. So also I want to remind you, last class, last three session, we were doing the rules of debit and credit. We know already now the two types of two approaches. That means one is traditional approach and modern approach. I told you now the class now onwards, or from the last two practicals session we have done, journal or debit and credit. From that onwards, we will focus modern approach of debit and credit, not traditional approach. So you have to understand very clearly the modern approach. Anyhow, we'll revise both. That is why I included, because for this all multiple choice, these rules are very important. Most of the, I think 50% of the MCQ directly or indirectly related to the rules, Kanuniya. So it is very important. So once again, both the rule we'll discuss. One is this is a modern approach. We have five groups: assets, expenses, liabilities, equity, and revenue. Out of this, assets and expenses, if you want to increase, or increase means debit, decrease means credit. Liability, equity means capital and equity both are same, I told you. Then revenue and income, it means liability, equity and revenue. Increase means credit, decrease means debit. Then another rules are traditional rule also. I'll just revise that, remind you. One is total accounts we classified into three groups: personal, real, nominal. Then I am not going more about personal accounts. Are the accounts of person, companies, banks, associations, or any other organizations are involved. It is called personal account. Real account, accounts of assets and properties. The nominal account, accounts of expenses, losses, incomes, and gains. But we focusing the rule. What are the rules? Personal account, debit the receiver and credit the giver. Real account, debit what comes in, credit what goes out. And nominal account, debit all expenses and losses and credit all incomes and gains. These rules I tell once again because these rules are very much very important in application of solving MCQs. Now another thing we have to discuss is we didn't discuss last class, but it is very important for your for getting the answer, for finding the answer of answers of MCQ. We have 100 MCQ, almost 2-3 session it will go on. I think it is 3 session it will go on, the MCQ, solving MCQ. I don't want just to give the MCQ and you by heart. You have to understand exactly how the answer comes. So these MCQ questions are the base or the core result of this what we discussed last 7 classes. The last 7 sessions, 7 hours, almost 7 hours, the class, if you go through and if you understand very carefully, you can answer easily. And also one thing we didn't include last class, that is types of adjusting entries. There are so many adjusting entries we have to study, but for the basic level or the ACCA, according to ACCA in accounting 1, that means most important adjustments, 5 adjustments are there. One is outstanding expense, prepaid expense, accrued income, unearned income, and inventory. Inventory means this is not the normal inventory, Makhzoon. This is inventory. This inventory is stock of supplies or supplies expense. Supplies. We will discuss all these things one by one. Outstanding expense. You have to understand clearly these 5 adjusting entries and their effect also, and also the last 7 session. So and this also, then you can answer almost all these 100, not 100. If any number of MCQ, it is time consuming to make the MCQ. That is why I made 100. Then if you go through the 100, it will be okay for you. You will be very strong. I'm 100% sure if you sincerely, honestly understand these 100 questions, it will help you a lot in your all these 6 courses. So anyhow, outstanding expense. Outstanding expense, or it is also called accrued expense. Accrued expense means expense due but not paid. It means you incur the expense, expense becomes due, but it is not paid. It is in Arabic, it is called nafqatu mustahaq. Mustahaq. What do you call? Mustahaq. Nafqatu mustahaq. That means you earned or you incurred the expense but not paid. It is called outstanding expense or accrued expense. It's a very important adjusting entry. Most often in final account, that means adjusted trial balance. While preparing the adjusted trial balance, you have to be in unadjusted adjusted trial balance everywhere, or in balance sheet, preparing balance sheet or any financial statement, everywhere you have to understand clearly what is outstanding expense. So not only for practical but also for this for solving the MCQs, multiple choice questions related to accounting. There will be a number of questions related to all these adjustments. So outstanding expense, one of the expense due but not paid, or expense accrued. It can also be called expense accrued, nafqatu mustahaq. That means you have to pay but not paid. It is your liability. So another thing you have to understand, outstanding expense is a liability, mas'uliyah. It is a liability of the business, and liability, you know already, always coming in credit. Liability always coming, it is a credit. Asset always debit. These all things you have to understand. Then only you will be find it very easy, the entry for adjusting entry. So there is an adjusting entry for any. For example, there are salary outstanding, salary due but not paid, rent outstanding, commission, wages, insurance, and electricity charges. Sometimes electricity bill has come, but you didn't make payment this month, so it is outstanding. Or this year itself completely you didn't pay the electricity. Some of the, for example, from January to December, out of that 2 months, last November and December, you didn't make payment, you will be paid next year. So it is this year, it is your outstanding expense. That means electricity outstanding or accrued electricity expense. So we'll check what entries are to be. Whenever there is an electricity or any type of expense outstanding, the expense, respective expense account. If salary outstanding, salary account. Rent outstanding, rent account. Commission, wages, insurance, whatever the expense, that expense account you have to debit. Because outstanding expense increase the expense. Expense is to be increased in your income statement. If expense is not increased, your profit will be increased. So that is the problem. That all you will, the effect you will understand later. The expense debit and expense payable or accounts payable. Sometimes some books it may be account payable, but better expense debit expense and credit accounts expense payable. If salary outstanding, debit salary and credit salary payable. Wages, if it is wages outstanding, debit wages, credit wages payable. If it is insurance outstanding, debit insurance and credit insurance payable. So this is the entry. So outstanding expense is a liability, and the entry also you understood, and it is what is the meaning also you understood. The expense due but not paid, and Arabic you understood already, nafqatu mustahaq. Then it will help you to easily get the meaning of outstanding expense. Another adjustment is, all these 5 adjustments we will discuss, and directly we will go to the MCQs, because before MCQ it is to be you have to understand clearly these all 5, because it coming in many MCQ questions are related to this. Other things sometimes it is slightly related, we can understand, but if it is not discussed, but these are the most of many questions are there. Out of 100 questions, there may be 10 to 15 questions may be related with these adjusting entries. Also, in for us, it is a full outcome. Out of 5 outcome, one of the outcome is adjusting entries. That means these 5 adjusting entries. So Next is prepaid expense. Prepaid expense means expense paid in advance. Sometimes it may also happen. Expense you may pay in advance. Dafa muqaddama. You are making advance payment. Sometimes salary or rent. In rent, if you are taking 1 month, 2 months, they are asking for advance. Or rent or salary or commission wages, any. It can also be called dafa musbaqa or dafa muqaddama. So you are paying the money in advance. Some expenses you are meeting in advance. Rent may be some insurance. I mean, insurance is a good example. Sometimes you have to pay for not for the month. You have to pay for the entire year. In the beginning, you have to pay insurance. Rent may be monthly you are paying, and electricity and all you are monthly you are paying. After it happens, you are paying. But insurance and sometimes advertisement expense or any expense you learn. So any expense may be paid in advance. Muqaddama, dafa muqaddama or dafa musbaqa. It is called prepaid expense. Now we'll go to the entry side of prepaid expense. Whenever prepaid expense is there, there will be 2 entries you have to write. For outstanding expense or accrued expense, there is 1 entry: debit expense, credit expense payable or account payable. But in prepaid expense, you have to write 2 entries. Now, so another thing you have to understand: prepaid expense is an asset, current asset. It will come always in balance sheet asset side. So prepaid expense is a current asset, outstanding expense is a current liability. Then prepaid expense, what is the entry for prepaid expense? All these 5 entries are so very important in financial preparation of final account, and also for MCQ, solving MCQ question also. So first 2 out of 2 entries, one is when you are making payment: debit prepaid expense, credit cash. For example, you are paying rent for full year. One month maybe 500 riyal rent you have to pay. So 500 into 12, 6,000 riyal full rent you paid. So what is the entry? Debit prepaid rent, credit cash. 6,000 riyal. 6,000. That is the journal entry. So debit prepaid expense and credit cash. Cash is going out. Prepaid rent or prepaid expense is an asset. Debit, increasing your asset. It's a current asset. When asset increasing, that is a journal entry also rule you can apply. Prepaid expense is a current asset. We have done that similar entries before while practicing. Debit prepaid expense. Prepaid expense is a current asset, debited, and cash is going out. So cash is going out or cash, any asset decreases, it will be credited. First entry. Then our second entry will be when this expense become due. Now 6,000 you paid rent. So you make an entry: prepaid expense, prepaid rent account debit 6,000 and cash account credit 6,000. Now 1 year is over, 1 month is over, January completed. So January rent become due now. So January 1 month is 500. 500 into 12, 6,000 we have. We have prepaid expense already, the balance is there. Now in January, when rent become due, expense account you have to debit. Here rent account you have to debit and credit prepaid rent account. Prepaid expense. So expense debit, prepaid expense credit. Or here rent debit, for this example, rent debit, prepaid rent account credit. How much? 500 riyal. So 2 entries. It's the effect and all. When you do, you will understand. Now you just understand the entries. When you pay full amount, it is a prepaid rent account debit, prepaid rent and credit cash. Cash is going out or asset is decreasing, and prepaid expense account or prepaid rent account is an asset. After that, prepaid rent account rent becomes due for 1 month, first month, or 2 months. First 2 months rent become due. So debit rent account and credit prepaid rent account. You have to cut this from prepaid rent from your asset, and rent is to be taken as an expense. Rent is to be considered because we know the expense accrual concept. expense is considered, expense is recognized when it becomes due, not when it is paid. That is why we are writing first entry, prepaid rent account debit and cash is going out. But when it becomes due only, we'll make rent debit and prepaid rent account we'll cut from that. For deducting, we'll credit asset account. Any asset account, if you credit, it will be deducted. So prepaid account, prepaid rent account will credit. So this is the entry. So prepaid rent is to be shown as a current asset in balance sheet. So these are the things to be discussed relating to prepaid expense or prepaid rent or any prepaid salary, prepaid commission, prepaid wages, prepaid insurance, any expense prepaid, electricity expense or any. Now, third item is accrued income. First, you have to understand the meaning. Prepaid means paid in advance, muqaddam. Then accrued income means income due but not received. You earned the income, you deserve it, you have to get it but didn't get. So that case also we have to discuss. Sometimes income becomes due but not received. So in that case, so income due but not received, so it will be received in future. So it is your asset, current asset. So accrued income is a current asset. Income due but not received. The dakhal mustahaq. It is same as dakhal mustahaq. That means income earned but not received. You earn it, you deserve it, you have to get it, but you didn't get so far. So this also, in this case also, you have to write the entry. Only one entry you have to write. That is income you have to debit income receivable. It's an asset. Debit income receivable. Income to be received or income receivable. Income accrued. Accrued income or accrued income and income receivable, both meaning is same. So income receivable debit and service income, it will add your income because you accrued, you earned, so it is to be recognized. So it is to be added in your income. So credit all incomes and gains, the rule. Or when income increases, it will be credit. So any rule you apply, that you will get the same. So income receivable. Why income receivable debit? Because it is a current asset. Income receivable or accrued income is a current asset. It should be debited, and service income is to be increased, or your whatever the revenue, service income or your revenue, sales revenue, whatever it may be, what type of income it is, according to the nature of income, you can credit. Whether it is two type of direct income, you know already, service income and or sales revenue and service revenue. So income receivable debit and service revenue you have to credit. So this is in case of accrued income, and accrued income is an asset, current asset. So this much you have to understand regarding accrued income. Actually, we have to practice. The whiteboard is needed for this to make the account and all. It will, otherwise it will take time. So you just understand, because our main purpose is to solve the multiple choice question, MCQs. How you apply this knowledge in solving MCQ. All the 7 sessions last discussed plus this topic, types of adjusting entries or different adjusting entries. It is very useful in solving the MCQs. Then fourth one is unearned income. What is it? Unearned. You didn't earn. It is not due. You received. Same as muqaddam. Dakhal mustalim muqaddaman. Dakhal mustalim muqaddam. That means you receive the income in advance, but it not belongs to this year or this month. That is called income received in advance. Or you can make like dakhal ayr muktasib. Dakhal ayr muktasib. That means you don't, that income you are receiving. You receive the income. It is a dakhal. Your income is coming to your business, but not belongs to this month or this year. So best term is, I think, dakhal mustalim muqaddaman. That means you are receiving in advance income, earned income. So this first you have to understand. Unearned, as it is unearned, it is your liability. It is not your asset. It is unearned. It doesn't belongs to this month or this year, whatever the period. It doesn't belong. So it is your liability. Mas'uliyah. That first you have to understand that term is very important. Unearned income is a current liability, because current liability, we are considering say current liability. After 2, 3, or before 1 year, it will become due. It will become earned, and you will transfer it. It will transfer to income, right? So now for the time being, it is not an income. So normally it is within 1 year, 2 months, 3 months after, it will become due. Income become due, then you will transfer to the your revenue. So it is always considered not more than 1 year. So it is a current liability. So now what the entry for that? When you receive income, debit cash. Cash is to be debited. Income is coming in. Then unearned revenue, that liability or unearned revenue is to be credited. Don't credit revenue or sales revenue or service revenue. Revenue don't credit, because if you credit revenue, it is considered it is an income. So unearned income, it is to be considered as a liability mas'uliyah, because you receive the cash, but it doesn't belongs to this month or this year, to the period. So cash debit and unearned revenue should be credited. And to second, this also coming second, 2 entries coming. Second entry, when the income becomes due, the unearned revenue you have to debit, and service revenue you have to credit. Service income or service revenue you have to credit. So 2 entries once again. First, cash, debit cash, credit unearned revenue. Whenever you get cash, cash is to be debited. Cash is asset, asset increase means debit. So unearned revenue you are crediting, because it is your liability increase, it should be credited. And when the income become due, when it is to be recognized, or when it is to be accounted as income in the books of accounts, at that time unearned revenue you have to debit, because that portion of unearned revenue you have to cut. Maybe full, maybe partially, you have to pass the second entry. Second entry may not be full, it may be partially also. Maybe out of 10,000, 5,000 is now it is become due. So unearned revenue account debit 5,000, and service revenue or service income credit. So this is an unearned revenue. Is always remember, it is a liability. You are receiving income in advance. Muqaddama, dakhal mustalim muqaddama, or dakhal ayr muqtasiban. So these are terms used in unearned revenue. Then now last one is inventory. Inventory, there are 2 types of inventory you have to understand. One is normal inventory, makhzoon. If it is stock, you know already stock will study when preparing financial statement. Stock is to be credited in, it is a direct expense on in trading account. In traditional method, that means in T form, in traditional T form. But in our new financial statement or ACCA approved financial statement, that means we have to adjust this in CGOS, cost of goods sold. Cost of goods sold, COGS. In that we have to adjust. Now cost of goods sold we discussed already before. Opening stock, add purchases, add purchase expense minus closing stock. So closing stock is or closing inventory. This is I am telling the inventory, normal inventory, the goods in which you are dealing. The stock or goods inventory means the stock of goods, the goods, unsold goods remaining at the end of the year, or at the end of the financial year, accounting year. It is called inventory, normal inventory. So normal inventory, in traditional method we are crediting in trading account. Closing stock is to be credited, and also closing stock is to be shown as a liability, as an asset in current asset in balance sheet. This all the adjustment, there will be two types of treatment, 2 places you have to treat. So one is inventory. Inventory is to be credited in trading account as it is a part of income. Then also it is to be shown as a an asset, current asset in balance sheet. That is normal. But now recently, according to, that is why you have both things you have to understand. According to our updated version of accounting, the vertical finance statement, what we are doing, we are adjusting with cost of goods sold. You know, last time we discussed gross profit. That means how do you calculate gross profit? Revenue or sales net revenue minus cost of goods sold. Gross profit minus all expenses, net profit. Then cost of goods sold is equal to opening stock plus purchases plus purchase expense minus closing stock. So closing stock is adjusted in cost of goods sold. So when you are calculating, there may be question related with cost of goods sold. So at that time it will be useful for you. So after cost of goods sold, although it is to be shown in balance sheet as a liability, as an asset. So this is normal inventory. Normal inventory means the goods in which the business is dealing. Then another thing is there, stock of supplies. That is very, very important to you to understand. Stock of supplies. If there is supplies you have to understand. There are except this direct material, that means goods in which the business is dealing. There are some other things, stationery, kartasiya, or it is also called adawatul maktabiya. So there are so many other stationery, pen, pencil. These all you are not buying for this month or this year. You are buying at lump sum and stock there. Stock will be there. From that you are using. So you have to calculate actual expense, actual amount spent for supplies. That you have to debit in your income statement. That is very important, because all the supplies you purchased this year is not the expense of this year, because all the pen, pencil, stationery material, other all the stationery items, calculator, everything you are not consuming. That particular period is not consuming. You are buying in stock, and from that you are consuming. You are taking. Whenever you take, you consume, you will be treated. It will be treated as supplies expense or stationery expense. So first you have to understand that it is also called kartasiya, or it can be adawat al maktabiya, or another term is lawazim al maktabiya. That means in office it should be very essential things. So lawazim al maktabiya. So these are the stationery items. That is also very, very important how to adjust. So this also apply the same. Stationery expense is equal to how much you spend for supplies is equal to opening stock plus purchase minus closing stock. Because when you start the business, you have 500 riyal worth of supplies. Plus this year you buy 2,000. So total 500 opening stock of supplies plus 2,000 by supplies purchased. So 2,500 minus you have 1,000 riyal supplies still closing, still stock, closing stock, still remaining at the end of the accounting year. So 2,500 minus 1,000. So 4,000 will be your supplies expense for this year. That's the place you have to debit. So there will be two entries for this also. When supplies you are buying for this year, and supplies from this total supplies, some expense you are charging to supplies expense. So first supplies you are buying. So office supplies, debit office supplies and credit cash. Cash is going out. If it is cash purchase or if it is credit purchase, the suppliers account, the account payable will be credited. Normal case, if it is cash purchase, we can take as an example. So office supplies it's an asset. Office supplies is considered, it's not an expense. It will converted into expense when it is spent. So first office supplies asset debit and cash credit. Then second entry will be supplies expense will be debited, then office supplies or asset account, office supplies will be credited. So two entries once again, office supplies asset account will be debited and cash account will be credited, because asset comes, cash goes. One asset comes, office supplies coming and cash goes. Here you cannot take it as an expense, office supplies expense or supplies expense account debit cash. But then what should be supply you have to use for complete entire supply. If you use for this accounting year, you can make that entry. No need to entry. Only office supplies, expense, debit, and cash. Finish. But supplies you are not using full supplies or stationery or pen, pencil, paper, all these things, all supplies you are not using fully. You are keeping a stock, and everywhere it is this system is followed. So what is the entry? Office supplies, asset account debit, and cash is to be credited. And when supply is to be treated as an expense, debit office supplies expense. Don't write both office supplies, it will confuse. Supplies expense debit and credit office supplies. Office supplies asset. So this is the entry. Anyhow, this entry, it will be little confusing for you as for the beginners. Others who have, for example, advanced diploma students, they may get it easily understand. They can understand, or BTech student can understand easily. Even BTech student has to understand so many things. There are so many, what you call, missing. So many things are missing. When we discuss, actually, the reason is why, you know, I give you 50 questions. 50 questions solved. That means in a PDF. You understand it, you study it, you by heart, and goes, you write exam, you pass. But if the same question repeat again, maybe after few months you may forget. It will not create any skill developing or any what you call your knowledge is not increasing. Memorize only, you memorize that. But if you understand this actual effect, each and every transaction or entry when you are writing, you have to understand the actual effect. Then not this transaction, every transaction you can apply this skill, this knowledge, it will help you. So that is why this 100, now we finished already all the 5 adjusting entries. We finish it, or I think it's okay. This knowledge is enough. Then whenever it is to be applied in MCQ area, we will discuss at that time. This is very, very important for the, it is a full complete outcome, and that is why we discussed it. Actually, without discussing this also, we can do so many of the questions, but this constitute a major portion of the MCQ. That is why it's very important. Anyhow, we'll go to the some questions we will discuss. We'll just start, and we'll next session will complete more. This is more than 100 questions. So 100 question means it will take at least, I think, 2 sessions it will take, but more than 2 sessions. 50 questions we cannot complete in 1 session. So it may be this 10 or 10 question we can complete now. But this question you have to understand, these all questions, there is 2 levels. One is HOT, higher order level. Second is lower order thinking, higher order thinking level, HOT, and lower order thinking level, LOT. So first question, it's okay, it's a medium moderate, but it can be considered for diploma first years and second years. It is a HOT question. Ahmed paid 500 real for the month's insurance this transaction. If you paid Ahmed or any businessman paid insurance, 500 real paid insurance, you know already 2 things are happening. Your cash is decreasing and insurance and expense is increasing. Now the alternative we can check. Increase an asset and decrease an asset. When expense is meeting, there is no increase of an asset because it is an expense, insurance. But you buy an asset means paid cash and bought furniture. So an asset increase, another asset decrease. That's a little different. But here expense is meeting. So that is not the option. Decrease in asset and increase in equity. Equity will not be increased. Whenever you spend money, your equity or your capital, your rasalmal will decrease. It will not increase. Expense, equity, you know already, equity increase when you bring money, when you invest money, when you make profit or revenue will increase equity, and when you spend money, expenses will decrease equity, and withdrawals, drawings will decrease equity. So 2 increase and 2 decrease. Investment, or you make capital or investment, and your revenues will increase or profit will increase, and your expense or losses will decrease equity, and also your drawings or withdrawals will decrease the equity. So here expense is met. So increase in asset and increase in liability. Your increase in asset anyhow it is rolled out. No increase in asset when expense is there. Only one decrease in asset and decrease in equity. Last one is exactly correct. This is a not a LOT question, HOT level. For the beginners, especially diploma first year, second year, all this HOT. Because decrease in asset and decrease in equity. Cash is going out, so asset is decreasing. And your equity, because expense is meeting. So if there is an option like a decrease in asset, increase in expense, it is okay. But as there is no option like that, the next best alternative option is a decrease in asset and decrease in equity. Any expense you are meeting, your asset equity or your capital is decreasing. So last one is the option. That also you will understand. It is a little HOT level question. You will understand. 2-3 times you think about, you will understand it. So owner's equity can be increased through owner's equity. An investor invest money in the business, owner's equity will increase. Or you will check more expense than revenue. If you more expense, equity will not be increased. Equity will increase when revenue or investment. Two things are there. When profit or revenue, if you make profit, arba or dakhal, or if you invest, istismari or rasalmal, bring capital, then your equity will be increased. So more expense, revenue wrong. Purchase asset, paying cash, no. Purchase asset and cash, no. Equity is related. Equity only for investment, revenue or profit, and increase and decrease in equity, expenses or losses, and also withdrawals. So withdrawals by the owner for personal purpose, no increase, it is only decrease. The last one is the correct option. Investment made by the owner. Owner make investment or capital, introduce capital, then equity will be increased. If owner make any investment, equity will be increased. Any type of it, whether it's capital or whether it's investment, any type of investment, any investment opportunities, then equity will be increased. So this is second one. Then another is this normal question. If the total assets of the firm is 100,000, outside liabilities 40,000, the capital contributed by the owner. We have studied, we discussed very clearly. There is an equation, accounting equation. Asset is equal to liabilities plus equity. Equity means capital, or asset is equal to liabilities plus capital or equity. Now total assets are 100,000. Then your liabilities, outside liabilities, it means liabilities. Your liabilities are 40,000. So if the asset is equal to liabilities plus equity, then equity is equal to asset minus liabilities. Then 100,000 minus 40,000. So D is the correct option, 60,000. D, 60,000. How you got? The basic accounting equation, asset is equal to liabilities plus equity. And you can make two more equations from there. Equity is equal to asset minus liabilities, and liability is equal to asset minus equity. So we are applying the second one. Equity is equal to asset minus liabilities. So asset is 100, liability is 40. So 100 minus 40,000 is equal to 60,000, and option D is the correct answer. This is a almost normal LOT type question. The both are there. In mixed, in our normal question paper, there will be, I told you, 40% HOT, higher order thinking, and LOT is 60%. 60% question will be average or knowledge level. The analytical or skill level will be 40%, 30 to 40%. So this is the question we'll think. Identify the result of not making an adjustment entries in accrued expense. So we discussed already accrued expense. there is an adjusting entry, debit expense and credit expense payable. What is that? Debit expense and credit expense payable. So if this entry is not passed, expense debit, expense payable, not credit, not passed, two effects will be there. That you have to understand first. But here after that, we go to the question. Two effects are, one is if expense is not debited, your total expense will be less. So your profit will be high, profit will be more. So under or decrease in expense or understatement of expense, total expense, or overstatement of profit. Profit may be increased or expense total will be less. This is one side. Then second side, if expense payable as a liability you are not doing, you are not crediting as a liability. Liability is not increased. There will be two effects for this. Understatement of liabilities. So that is actually, it is the right answer is understatement of liability. Liability will be less. When liability less, what will happen? Your balance sheet shows less liability. So both are coming at a time. This two important effect. One is overstatement of profit and understatement of liabilities. This is the ultimate. The other one, expense overstated, that's okay, but the effect is expense is understated, so expense is less. So overstatement of profit and understatement of liabilities. Two result will be there because of if you are not writing the entry. Now we can check. Overstatement of expense, no. Expense if understatement is correct, but no, it is overstatement. Overstatement of liability is not more. If you are not writing this entry or the identify the result of making adjustment rates, not making, you didn't make, not doubling, that also may come. If you make the adjustment double or twice, what will happen like that? So it is, if it is not made, what will happen? Understatement of liability. Understatement of liability, third one. Understatement of capital will not be affected. So the C answer, option C is the correct answer. Understatement of liability. Liability will be understated. Your total liability will be less. Or your profit, net profit will be overstated because expense, you miss some expense. So if any, sometime maybe both interchangeably may coming. Understatement of liability and overstatement of profit. Another is understatement of liability and understatement of profit. Overstatement of liability and understatement, like options will be there. So in that case, the correct answer is overstatement of profit and understatement of liability. But in this question, it is only one option, one side effect is given, understatement, because overstatement of profit is not given. Otherwise, overstatement is there as an alternative for this. It will be two answer will be there. So this is a, so go through exactly what happens and find the answer. So next one is assets of 48,000 and liabilities are 18,000. The total liability of the balance sheet will be. This is another question. This is normal question. LOT. 48,000 is assets and liabilities are 18,000. You know already. This is also basic accounting question. Asset is equal to liabilities plus equity. So 48,000 is equal to liabilities 18,000 plus 30,000 equity is already given 30,000. But the answer is not that. 30,000 is the equity. Answer is total of liability side of balance sheet. Balance sheet always the assets, total of asset side, total of liability side should be equal. So if it is asset side is 48,000, then liability side also you have to get 48,000. So answer is 48,000. It's a A. But equity is 30,000. If it is question is like if how much is the equity, then it is 30,000. So you can understand asset is equal to liabilities plus equity. So 48,000 asset is given and liabilities are given 18,000. So equity is 30,000. But total liability side of the balance sheet will be 48,000. So total asset side and total liability side will be always equal. So 48,000. Option A is the correct answer. Then we have which among the following have a debit balance? It's also easy question. This is all related to rules of debit and credit. Increase in liability. You know already, liabilities, equity and revenue increase means credit. So it is not the answer. Increase in asset is correctly. Asset or expense increase means debit. So increase in asset. Another is increase in revenue, increase in equity, all credit. So it may be question may come different way. Which among the following is not? It's a question. Accordingly, the answer will be changed. Which among the following is not a credit balance or not having a credit impact or credit aspect? Or it may be like which among the following have a credit balance or credit effect, like that. Maybe accordingly the answer should be changed, but you understand it's directly related to the equation. Assets or expenses, when increasing it will be debited, decreasing it will be credited. Then liabilities, equity and liabilities, equity and revenue, increase means credit, decrease means debit. So all increase liability, revenue and equity, all are credit aspect, and increase in asset and expense. Asset is a debit aspect. So we have to go to the accrual expense or the expense which we just discussed. Accrued expense, expense due but not paid, have incurred but not yet paid. Incurred or due both are same meaning. Then have been incurred already paid. Incurred and paid is not like that. Have not incurred but paid, not incurred but paid, it is muqaddam advance. Then have not incurred but not paid, not incurred, not paid, it is just for option only. So first is the best correct option. Have been incurred, already you incurred but not paid, due but not paid. So accrued expense is nafqatul mustahaqa, that means due but not paid. Have incurred but not paid. So that is the correct answer. Now we will go to the payment to suppliers. When you make payment to suppliers, creditors, account payables, you are making payment. Increase on asset and decrease in asset. First you understand, whenever you make payment, your cash or an asset decreases. And here you are making your liability holders, liability, it's account payable is a liability, supplier is a liability. So when you make payment, supplier liability will decrease. So asset and liability both will decrease according to when you make. So check the option. Decrease in asset, decrease in owner's equity. Decrease in asset and decrease in liability. Increase in asset and increase in liability. So only one option is the decrease in asset and decrease in liability. Because account payable or what you call account payable or your account payable or sundry creditors or bills payable or bank loan, qard, anything when you make payment, your liability will decrease. Asset will also decrease, which cash is going. So decrease in asset and decrease in liability. C is the correct option. So next is the portion of earnings distributed to shareholders is called, you know already, dividend. Profit, portion of profit, you distribute to shareholders, equity shareholders or stockholders is called dividend. What is the retained earning then? The portion of profit, it is retained in the business. Total net profit is 100,000. Out of that 25,000 you retain. You retain. Retain may also reinvestment. Reinvestment of earning, retained earning, recapitalization, plowing back of profit. This is all same time. You are using that profit again in the business. Then only you can increase your net worth. If you check all the companies which is become a multinational companies, from a small company it become a big many branch, hundreds of branches, like for example Lulu. You can take Lulu LLC. Lulu, no, they made one branch first, in a small branch they started in Abu Dhabi. Now they have more than 100 hypermarkets. How? Retained earning. They make profit, again reinvest, reinvest. It becomes increase the net worth. So like that, retained earning, the reinvestment of earning. It is called recapitalization, retained earning, reinvestment of earning. It is also called a technical, more financial term is plowing back of capital. So answer is dividend. Then expense and loss, it is not the portion of profit distributed. So correct answer is dividend. But understand that maybe some question come next time. The portion of profit which is retained or reinvested in the business is called retained earning, dividend. Any other terms may come. So retained earning will be the correct answer. So now we'll go to the some more, because we have 105 questions. So it will take a lot of time. So we are not extending. This will finish by this. Which of the following does not appear in balance sheet? You know already. Income statement or profit and loss account and balance sheet are the two important, or a statement of financial position or balance sheet. Profit and loss account is called income statement. So income statement and financial statement of financial position are two main financial statements. So income statement, what is the income statement? Consists all expenses, losses, incomes and gains. 4 items: expenses, losses, incomes and gains. Then balance sheet, there will be 3 items, which are this: assets, liabilities and equity or capital. So actually assets and liabilities too, but in modern balance sheet, in modern that means equity, we have to specify. Equity is to be shown separately. So assets, liability, capital, equity. These are the balance sheet. And expenses, losses, incomes and gains are included in income statement or profit and loss account. Now here you see balance sheet does not appear. Building is an asset. Copyright, building is a fixed asset. Copyright is a intangible asset. Intangible. And patent is also an intangible asset. And insurance is an expense. So insurance is an item which belongs to income statement. It is not belongs to balance sheet. So the correct answer is insurance. Insurance, insurance is a just indirect expense. So the journal entry for purchase of goods from Ahmed on account. We have done many transactions like that. For purchase of goods, you have to debit purchase account. Purchase of any asset account: machine, building, plant, furniture, fixtures, vehicle, anything you buy, that account, asset account will be debited, and if it is on credit, account payable will be credited. Here if you buy goods on credit, debit purchase account and credit accounts payable. So debit accounts receivable, no. Debit purchase and credit account payable, yes. B is the correct answer, debit purchase account, because goods and credit accounts payable. Accounts payable means sundry creditors. Then debit purchase and credit cash, no cash payment. Debit cash and credit account payable, cash is not coming. Debit cash will be debited when cash comes in, but there is no cash is not coming. That is why you are making purchase of goods on account. So debit purchase, credit account payable. So we'll do one thing. We'll next session also we have still around 10 transaction, 10 or 12 transaction to discuss. Entries, so MCQs which discuss. We have a lot of MCQ, and we'll continue the session. Next session we'll continue more MCQs, and we'll stop here. Thank you. Thanks a lot.